Hey everyone, welcome back to Trade Radar USA, your daily radar for what's really moving the US stock market. Today's session was not just another red day. We saw stocks slip again, bank earnings shake confidence, tech finally cool off, and money quietly rotate into commodities and defensive plays. Before we break it all down, make sure you subscribe to Trade Radar USA, turn on notifications, and hit that like button so you never miss a market-moving update. On Wednesday, January 14th, 2026, U.S. markets closed lower for the second straight session. The S&P 500 edged down, the Dow Jones slipped modestly, and the Nasdaq led losses, dragged by weakness in both financials and technology. This wasn't panic selling, it was something more calculated, profit-taking, rotation, and positioning ahead of key economic data. Let's start with bank earnings, because that's where today's pressure really began. Some major banks posted earnings beats. But here's the problem, stocks still fell. That tells us investors aren't impressed by backward-looking numbers anymore. They're focused on loan growth, credit quality, net interest margins, and guidance for the rest of 2026. When even beats don't spark rallies, it's a clear sign confidence in the financial sector remains fragile. Next up, tech stocks. After carrying the market for months, the tech sector finally showed real fatigue. Semiconductor and AI-linked names pulled back, sending the Nasdaq to its weakest session in weeks. This doesn't mean the AI story is dead, but it does mean valuations are being questioned. In 2026, markets are far less forgiving. Growth stocks now need execution, not just excitement. While stocks slipped, commodities quietly moved higher. Oil prices climbed on geopolitical concerns and supply risks. Gold and silver surged as investors looked for protection against uncertainty. This tells us something important. Money isn't leaving the market, it's rotating. That's classic late cycle behavior, and it often appears before larger trend shifts. Here's how the major indexes finished. S&P 500 down about 0.5%, Dow Jones slightly lower, Nasdaq down roughly 1%. Meanwhile, small cap stocks held up better, which suggests this was not a broad market breakdown, just targeted pressure in crowded trades. Even before the opening bell, futures were pointing lower. Earnings uncertainty, valuation concerns, and mixed global signals set a cautious tone that never really recovered. This is why pre-market sentiment matters. It often reveals how institutional money plans to behave once trading begins. Zooming out, global markets remain uneven. Inflation data has cooled slightly, but not enough for central banks to fully relax. Rate cuts are still a discussion, not a guarantee. And remember, markets move on expectations, not headlines. That's why traders are positioning carefully rather than chasing rallies. So, what should you take away from today? This was not a crash. It was a warning about stretch valuations. Financials remain under pressure. Tech leadership is being challenged. Defensive assets are gaining attention. What to watch next? Inflation data, the next earnings wave, whether commodities keep outperforming. These signals will shape market direction into the next few weeks. To wrap it up, markets pulled back as earnings disappointed, tech cooled, and money rotated into safer assets. This isn't fear, it's repositioning. If you found this breakdown helpful, subscribe to Trade Radar USA, hit the bell, and drop a comment below. Do you think tech bounces back first, or do financials finally stabilize? Smash the like button if you want daily US market analysis without the noise. Thanks for watching Trade Radar USA. I'll see you in the next update.